SPLG and VOO give you the same S&P 500 exposure. They hold the same companies, follow the same index, and deliver the same market risk. So choosing between them is not an investment decision, it's an implementation decision. And where that difference shows up is not where most people expect. SPLG and VOO both provide exposure to the S&P 500. They track the same index and hold the same large US companies using the same market cap weighting methodology. The same sectors, in nearly the same proportions, representing the same US large cap equity market. At the index level, the exposure is identical. What differs is not what is owned, but how that exposure is delivered once it's wrapped into an ETF. Those differences show up in implementation mechanics, which becomes relevant depending on how the ETF is used. The most visible difference between SPLG and VOO is cost. Both funds track the same index, but the difference shows up in the expense ratio. The expense ratio is the fund's annual operating cost. It's deducted internally and reduces returns slightly each year without changing risk or exposure. At current levels, SPLG 0.02%, VOO 0.03%. On a six-figure portfolio, the difference is measured in tens of dollars per year, not hundreds. That gap does compound over time, but because both funds already operate at extremely low cost, the absolute impact remains modest for most investors. Where cost actually matters is not the headline number, it's the context. Expense differences matter most when the holding period is long, the allocation is large, and the ETF is used as a permanent core position. At this point, structure and implementation matter more than price. Any difference between SPLG and VOO only matters in context. That context is how the ETF is used in the portfolio. If the ETF is used as a core long-term allocation, held continuously, rarely traded, often inside retirement accounts, then expense ratio differences compound gradually, and day-to-day trading liquidity is largely irrelevant. If the ETF is used as a trading instrument, frequent entry and exits, option strategies, short-term reallocations, then liquidity and trading volume matter more, and execution quality dominates small fee differences. In other words, long-term use, costs matter more. Short-term use, liquidity matters more. The correct choice is determined by portfolio role, not by market forecasts, performance expectations, or return predictions. SPLG is most appropriate when the objective is efficient, long-term exposure to the S&P 500. SPLG fits when position is buy and hold, contributions are regular or automated, trading activity is minimal, and option strategies are not part of the plan. In this role, market exposure is identical to the other S&P 500 index ETFs. The lower expense ratio provides a small but persistent cost advantage. There's no difference in diversification, risk profile, or return drivers. When the goal is long duration market exposure with minimal friction, SPLG fulfills that role cleanly. VOO is most appropriate when trading flexibility and market depth are priorities. VOO fits when positions are adjusted actively, trade sizes are large, intraday executions matter. In this role, higher trading volume supports consistent execution, and liquidity remains reliable across market conditions. The higher expense ratio is not a drawback in this context. It reflects scale, depth, and execution efficiency. When access, liquidity, and tactical flexibility matter more than marginal cost differences, VOO fulfills that role cleanly. SPLG is priced aggressively within the S&P 500 ETF category. The lower expense ratio reflects a deliberate pricing decision by the issuer, designed to compete on cost rather than differentiation. Importantly, the lower fee doesn't signal weaker index tracking, higher volatility, or higher risk. SPLG follows the same S&P 500 index, uses the same rules and rebalancing schedule, and holds the same underlying constituents as the other S&P 500 ETFs. The difference is not exposure or design, it's pricing. SPLG competes by reducing friction, not by altering the investment outcome. Because SPLG and VOO track the same S&P 500 index, their long-term behavior is nearly identical. This section exists to remove common hidden risk concerns without changing the decision framework. Tracking differences between the S&P 500 ETFs are typically measured in basis points, not percentages. That means small deviations around the index are driven by fees, timing, and operational mechanics, not by differences in holdings or strategy. Over long horizons, the index dominates outcomes. Implementation differences exist, but they're small and don't reliably change long-term returns. This is why reported performance between core S&P 500 ETFs often looks indistinguishable over time. VOO's larger asset base supports consistently deep liquidity and reliable execution, especially for large or frequent trades. SPLG is smaller by comparison, but still operates well above any practical viability threshold for normal investors. Creation and redemption function normally. Bid-ask spreads remain tight, market access is stable. Scale affects how easily trades are executed, not what the ETF owns or how it behaves over time. Both SPLG and VOO use the same ETF creation and redemption mechanism to minimize realized capital gains. As a result, capital gains distributions are rare, ongoing tax drag is minimal, and differences are usually driven by investor behavior, not fund design. In taxable accounts, after-tax outcomes are effectively the same, unless trading behavior differs significantly. Vanguard and State Street are both large, regulated ETF sponsors operating under the same US framework. Sponsor choice doesn't change. Holdings, index methodology, risk exposure, and expected return behavior. For passive S&P 500 ETFs, the sponsor affects branding and scale, not investment outcomes. This section only matters if you trade, rebalance frequently, or use options. VOO trades with higher daily volume and deeper overall market activity. As a result, VOO provides consistently narrow bid-ask spreads, higher reliability for large trade execution. SPLG trades at a lower volume, but remains fully liquid for its intended use. In normal market conditions, SPLG offers tight bid-ask spreads, reliable execution for typical retail trade sizes, and no meaningful liquidity constraint for buy and hold investors. For long-term investors who buy and hold, portfolio outcomes are unchanged by trading volume. Liquidity is a functional consideration, not a return driver. Its relevance depends entirely on how the ETF is used. SPLG trades at a lower share price than VOO. This improves implementation for investors who contribute fixed dollar amounts. In practice, a lower share price allows more precise deployment of new contributions, less uninvested cash between purchases. This matters most for smaller account balances, automated or recurring investments, or brokers that don't support fractional shares. The lower share price improves execution efficiency only. It doesn't change market exposure, risk, or long-term return expectations. The decision between SPLG and VOO is structurally straightforward. Both provide exposure to the same S&P 500 index, identical underlying holdings, and the same role inside a diversified equity portfolio. The difference is not strategy, it's implementation. The choice comes down to lower ongoing costs versus greater scale and liquidity, and efficiency for long-term holding versus flexibility for active use. Neither fund is superior in isolation. Each is optimized for a different use case. The correct choice is the one that aligns with how you actually invest, not with branding, popularity, or perceived prestige. Continue with the next video, it builds directly on this.